Good morning. This is the video newsletter for Buy Sell Short for Sunday, August 14th. Crazy week on Wall Street. Uh, we went from down 600, up 400, down 500, up 400, and then finally we were able to break that streak and get a second up day in a row, with Friday being up 100 plus. This is the first 2 day win streak, if you can believe it, since the top back there in the first week of July. So we went a month without having two up days in a row. Deeply oversold still on the market, but we have very skittish traders still out there. Thursday and Friday, we saw an absence of those crazy computer programs that have essentially fueled this huge tank, especially over the last week. We saw a small little robot attack midday on Friday, but really didn't have a whole lot of strength, and we were finally able to bounce into the close with the shorts kind of throwing in the towel ahead of the weekend. We still have that European issue hanging over our heads, and it's probably going to continue to do so over the near term. And what we're likely going to do is just climb a wall of worry, which is what we've done after every big tank over the last 2 years. As you can see on the Dow, we hit that first target of the 8-day moving average on Friday. Secondary target is a move back to the 20-day exponential. And these are my two favorite moving average, especially after we have stocks and indices get hammered. They always get a snapback rally to these moving averages. Let's look at the 15-minute chart. Here we have the 15-minute chart. We found resistance right at the 38% Fibonacci retracement there on Friday. I think we actually kissed it right on the cheek. 11,378, I believe, was a 38% Fib retrace. You can see right now what we're looking for. We mentioned in the video there last week was a golden cross on the 15-minute. That is when the 50-day moving average, the blue line, crosses up through the 200-day moving average, and that is the red line. We're probably looking at that happening maybe tomorrow, but definitely by Tuesday, unless we see some out of the blue tank in the market again and the robots attack. And the average gain on such a cross is about 150 points going back the last several years. Granted, now 150 points, given the crazy 400-500 point up moves and down moves we've been having over the last 2 weeks, really doesn't mean much. On a side note, let's go back to the daily chart. You'll recall back in late June, early July, I posted that link and that information about the M2 money supply. And you recall me saying that the Fed QE3 is underway. It's not been officially said, but what the Fed is doing with money supply right now is QE3 as far as I'm concerned. Recent data, or the latest data, just came out on Friday, and over the last 2 weeks, the Fed has pumped in $159 billion in liquidity into the M2 money supply, and that brings the 3-month total to $472 billion pumped into the money supply over the last 12 weeks. And just to put that in perspective, the entire M2 money supply increase in 2009 and 2010 together, both those years, was about 270 billion each year. So in the last 12 weeks, we have essentially had more liquidity put in than in the last 2 years combined. And if the Fed keeps up this pace that they've been going on over the last month or so, we're looking at them increasing the M2 money supply at an annual run rate of $2 trillion. So if you're wondering what the fuel is going to be for a market rally, it's all the liquidity, and the Fed is just pumping liquidity in right now. And you recall that last big liquidity pump that we had from the Fed, the market ended up running 800 points. So the Fed is on pump mode right now with interest rates, with them locking in the date. Companies, funds are able to price in what it's going to cost to borrow over the next 2 years without any fears of rate surprises. Very, very big. It'll probably take a little while for this to feed into the system, but just based on this, my view is the market is going to be significantly higher over the next several months, and that is my call right there. You've got all the doom and gloomers out there saying it's the end of the world, we're in a new bear market. In my opinion, they are wrong. And, it looks like the annual bottom, which typically we look to see happen in September and October. Over the last 2 years, it's happened in August, and we had our August event to possibly bottom the markets here again in August. So I think the bottom is in, or pretty damn close. We will likely see after, especially if we get that push up to the 20-day exponential, we're going to see some backfilling. And we may even see another test under the 10 or 11K mark, over the next couple of weeks or the next month. Very ordinary or very typical to see that happen, especially after the size of the sell-off we've had. SMH, you can see here, nice little bounce on this one. We're still looking for that move back to the 20-day exponential. We booked some nice gains on half our position on the SMH on Friday. And, if we do see another dip on the SMH, we'll look to pick some up. But like pretty much all the indices, deeply oversold and, essentially victim to the news flow. Now, you see this setup here. You're going to see this on a lot of the charts. Big sell-off, bounce back, red candle. This is when the shorts come in. This is when traders book profits, get scared, move out. This is not untypical, especially after the size of this setup, and you'll see it on a lot of stocks, especially ones that had big bounces. You see them bounce, get a red day or two, and then rebounce higher. So that's what we're looking for on a lot of these plays. Quick mention on the VIX. We're looking at the VIX monthly chart, and you can see these spikes over the last couple of years. This was the 2008 crisis when we spiked up to that 90 level, and you see essentially what happens is we have, and this is common in all these tanks if you go back, 2-month spike. We had a 2-month spike back there in 2008. Here was the flash crash back in 2010. We had a 2-month spike, that spike up to the 49 level, and then we retraced. Here we're going on 3 months right now on the spike, especially over the last 2 months, on a spike right to the same level we saw back in the flash crash of last year. So the VIX possibly could see another respike, but fingers crossed that we start to see this move back down over the next couple of months. As for stock plays, let's look at some interesting charts. MOVE on the radar for this week. This is probably the cheapest internet stock out there. They came out with earnings during the market crash, and they actually posted EPS, unlike those other garbage real estate companies like, the name escapes me right now, Away that just did its IPO, and Xylo, which is a bloated crap if you ask me. Target here, 20-day exponential 184. Would love to pick this one up in the low 150s or possibly under. Stops at $1.43, and the target would be the 184 level. Like I said, I believe this is the most undervalued internet stock out there, and now they're starting to turn the corner and posting profits in this crappy market environment. So definitely one to keep an eye on for this week. ALVR, you can see we had some redness on Friday. We're still waiting for the volume to come in here. Sellers are still a little bit back. They make money, cash flow positive, so it's not a junky stock, which is probably why it's going to take a little while longer to get going. But our target still remains 20-day exponential 134, and would be looking to add any dips 120 and under. Bios continue to do very well, which is not really a surprise, because when you see the speculative money start to move back into the market, biotechs is typically where they go. We had some big movers off that rally list I sent out at the bottoms on Wednesday. I believe every single one of those plays up nicely over the last couple of days. ALXA decimated over the last month. It's been treading water here. We're probably going to need a break of 130 to set this one free with a move to that 20-day exponential up there at 184. RSI, the most oversold it's been in a year. Stochastics under the 20 level. This is where we like to pick stocks up for easy bounce backs. CWTR, retail stocks starting to rebound a little bit here. Volume has come into this one over the last 2 days. Nicely oversold. Unbalanced volume, let me scroll down, has started to tick up with Stochastics and RSI in the basement. As you can see, this is a stock, tends to bounce back to its 20-day exponential, 109, so we've got 20% upside on this one over the next few days with rock-solid support at 82 cents. Should be a very nice week on this one. CYCC, another bio, just hit over the head. Again, same theme, 20-day exponential, 98 cents. Deeply oversold. RSI coming up from oversold levels. Stochastic still oversold. And, one decent risk reward here, trading right around cash value right now, which is insane, especially if we see the spec money start to flow back into these plays. IKAN, really like this one, $1.10 under for a move back to that 50-day and 200-day moving average up there in the 120s. Now, typically, whenever we have a big market tank and small caps get decimated like they do, I tend to gravitate. We always trade in the under $5 stocks, but I really love, especially in times like this, focusing on the stocks trading $2 and under. They tend to give the best returns because typically they get decimated the most. If we start to see these under $1 stocks really start to bounce, we'll start to move more into those. But the focus really low $1 to $2 is what we're going to be looking for. And I went over on Thursday in the video sort of the setups we're looking for: down big, consolidation, and a repop. And many of these you're going to see them down big, pop, have a red day where traders get scared at, and then they move higher as the weekends get out and stronger, bigger balled traders hold on to them. So that's what we're looking at this week. We're probably going to see some more volatility, but keep in mind, the positive thing about those huge up and down moves with the robots last week, the robots are killing each other. Funds are losing a fortune. People think that when you see those huge up and down moves with these robot trading programs that they're making money. They're not. The big down moves, the short robots make money. Then the buy robots come in and they kill the short robots, and vice versa. So we're seeing a lot of hedge funds blow up right now. A lot of traders who really don't manage their portfolios pretty well and overinvest in these triple short ETFs or triple long ETFs, which I think are garbage and should be avoided at all costs. Our strategy has worked perfectly, I believe, over the last month. We've been high cash. We've been picking up some bottom plays now over the last couple of days. And as traders who didn't and got wiped out over the last couple of weeks, we're able to swoop in, even having high cash stance, and nibble at some of these bounce plays. And we're going to continue to do that. If things perk up and we start to see that market really move to that 20-day exponential during the next week, you'll start to see more email plays. As for now, we're going to continue probably to trade more of these in the chat room. And, when we see these really good setups, look at your inboxes for some new, possibly swingy plays. And right now, we're still taking a half position stance. And, lengthwise, we're still far away from holding plays for 2 weeks or more. Right now, I would view 1 week as long-term on some of our plays. So that's it for the video. Again, if you've got any questions, feel free to send me an email. Otherwise, I will see you guys in the chat room tomorrow. Good night.